Okay, here we go. Harach. Thank you.
Welcome, everyone, to the November webinar for the San Fernando Valley Bar Association's Taxation Law section. I'm so happy that all of you took time of your schedules to attend this very timely and informative topic. Before I introduce our speaker, I just want to recognize and give a silent applause to Seth and Linda for putting on an outstanding installation gala. I thought it was fabulous. Unfortunately I wasn't able to attend, but congratulations, Seth and Linda, for the event, and what a great way to end the year. Um, so I invited Jurate Gulbinas to talk about this foreign information reporting with respect to gifts and trusts. And this is an area that's a trap for unwary. And um, I think all of you should be well informed on this. And it could happen very subtly when you get a call from a client. Oh, I have a family member overseas that's going to send me some money. A light bulb should go on that there might be some reporting requirement. There's no tax liabilities due, but there's forms required. And Jurate will go into that and the severe penalties involved. And our speaker today is an attorney, CPA or CPA attorney. She's dual licensed in uh, California. She received her undergraduate degree in her home country of Lithuania in literature and psychology, and received an MBA from National University and MS in taxation from Golden Gate University with an additional certificate in international tax, also from Golden Gate. And finally, she topped that off with a Juris Doctorate from the Mitchell Hamlin School of Law in Minneapolis. She's currently a principal of Gulbinas Law as an attorney and as a tax professional CPA of CST Tax based in La Cañada, California. Thank you, Jurate, for being here. And before she starts with the presentation, if you have any questions, if you don't mind putting in the chat box, I'll monitor the chat and I'll pose the questions to Jurate as appropriate and at the appropriate times. Jurate, thank you for being here and thank you for the presentation.
Thank you, Haraj. Thank you, Linda, also for your kind introduction. So let me set a scope for our hour, and it will go quickly. I deal a lot with international clients. Most of our clients have some sort of international flavor, and the international tax issues are dynamic. Things constantly change, they evolve. And this is especially true when it comes to international tax reporting obligations and foreign trusts. So a lot of clients come to us after the fact. Either somebody else prepared the US income tax returns, they moved from a foreign country. Part of the package was that one of the bigger firms was preparing the tax returns, or they went to a local CPA in the town where they live, and they prepared US tax return, and they claimed when they come to us that, well, nobody asked us about those foreign assets. Or they say that, well, we told everything to the preparer. CPA attorney about our foreign assets, but they told us, don't worry, you don't need to report. In any case, there is this thing that is unreported. And there is that something a company or an account that could be a trust. Client thinks that it is a trust, or because it is called a trust in a foreign country, or there is an account that it is not even a trust in their mind, but could be treated as a trust for US tax purposes. Let's just say like Australian superannuation accounts. So those could be foreign trust. So then we will also look why it matters whether the trust is domestic or foreign, because the reporting duties depend a lot on how this trust is classified for US tax purposes. We will look into foreign grantor and non-grantor trust, and then we will look into various the filing requirements. So let's start with the most basic question. Is this entity a trust? For US tax purposes, we do not care how the entity is called in a foreign country. It can be called a trust in a foreign country and can be a business, so-called business trust, or a business entity for US tax reporting requirement. What we care is the federal rules. What we need, we know all of us, what we need a grantor, we need a title that transfers to the trustee to basically to protect that property. We need a property and we need designated beneficiaries. So then once we determine that this entity that we have on our hands is a trust, then we look whether it's a foreign or domestic trust. And sometimes it is quite tricky to determine whether that trust is a foreign or domestic. Every trust is a foreign trust according to the tax code because you have to meet two requirements. It has to be court test and control test. Court test, what it means that U.S. court has a jurisdiction over this trust, and control means that U.S. persons have control over the foreign trust. And lately, we've seen quite a lot coming from other attorneys, estate planning attorneys, who have this problem on hands. Somebody died, let's just say just recently, somebody died in Long Beach. There was nothing for that person. He just had a house. There is a trust. And the beneficiary then becomes a trustee, and that trustee is an Australian citizen, lives in Australia, and not even a U.S. green card holder, not a U.S. citizen. So there is a trustee that lives outside of the U.S. The trust becomes a foreign trust. So there are ways that you can remediate if you find that the trust became a foreign trust. It has to be done within 12 months after you find that out. So now that we know that we have a trust, it is a foreign trust, then the next question is, what are our reporting obligations? And those vary depending on who has to report something for that trust. So we have basically there are just few people or entities or responsible parties that matter for foreign trust. So we start with a responsible party. A responsible party, it is somebody who has to file when a certain event happens. So it's an event-based reporting. There is a need to file 3520 if, let's just say, grantor died, or there is a transfer of property to a foreign trust. So responsible party has to file 3520 to report that transaction to the IRS. The next level is an owner or grantor of that foreign trust. So that person has a lot of responsibilities. He has to get a financial statement for that foreign trust. He has to prepare that financial statement that is prepared according to the US filing, according to US requirements. And he has to ensure that 3520 the statement is given to all the beneficiaries that need to file and report the distribution from that foreign trust. And then finally, there is a 3520 filer who is a US person who receives a gift or a distribution from a foreign trust. So now we have a foreign trust, we know the obligations, how we need to file, then we come to the grantor trust. And grantor for the in this case again, we look who has a control over that trust, who retains certain powers in that trust. And basically, once we have this foreign grantor trust, grantor will report that income on his tax return, whether that income is distributed or not. Non-grantor trust is a trust that where grantor doesn't retain any powers over that trust. So there is I prepared for you like a quick summary, a cheat sheet for you to look when you have a grantor versus non-grantor trust and how the income is taxed. So we have a grantor domestic trust. Domestic grantor will be taxed on the worldwide income. Non-domestic owner with the U.S. grantor trust, he is going to be taxed only on ECI and U.S. source income. Now, when we have a non-grantor trust, the trust is taxed on the worldwide capital gains and undistributed income. For a non-grantor trust, again, is taxed only on effectively connected ECI and U.S. source income. U.S. beneficiaries for the grantor for the U.S. non-grantor trust are again taxed on their share of worldwide income, excluding capital gains. There is a difference, so that is the very significant difference between U.S. domestic and foreign non-grantor trust. Capital gains are always included and the proportionate share of the beneficiaries in a foreign non-grantor trust. So they are included in distributable net income. Foreign non-grantor trust can be very tricky for the U.S. filing obligations, for the U.S. reporting obligations. There are a lot of horror stories if you look into tax notes, if you look into any international tax publication. The worst case scenario, you can end up with the U.S. tax obligations that are higher than actual asset in that foreign trust. And now, if we have non-U.S. beneficiaries, they are just taxed on in the U.S. effectively connected income and U.S. source income that is distributed during the year. So when we have a grantor trust, we have U.S. person. You have a U.S. person that is a grantor because he transferred a property or cash to the foreign trust. That U.S. person is going to be taxed on that income in a foreign trust, whether that trust distributes any income or not. Even if that is a complete gift, the U.S. person is going to be taxed on that income generated in a foreign trust. There are some exceptions for that if you transfer because of debt, if you transfer for fair market value, meaning that basically it is a sale. It is a sale of your property to a foreign trust. Now, foreign grantor, it is when you have a foreign grantor trust and U.S. beneficiaries, that's the dream situation for the U.S. beneficiaries because the foreign grantor is going to, for the U.S. tax purposes, it's deemed as if he's receiving all the income. That's why U.S. doesn't like foreign grantors, and there are only limited trusts that can be foreign grantor trust. So it has to be a revocable trust where the settlor has the power to revoke that trust without consent of any other party. So you have to revocable trust that is a foreign trust. The settlor is foreign. He has all those powers. So that's a foreign grantor trust. Then we deal a lot with those when you have a grantor and grantor's spouse. Grantor could be non-resident and the spouse could be resident. So those have to be irrevocable trusts, and the trust document should be extremely specific that the trust is benefiting only the grantor and the grantor's spouse during the lifetime of the grantor. Oh, and those amounts are distributable to them. It's most of the foreign trusts are not going to end up being foreign grantor trust because of those specific requirements for the U.S. tax purposes. There are some foreign compensatory trusts that are also treated as a compensation for that person, and they could be seen as foreign grantor trust. So what could happen in some with a certain trust or some trust when you start with that foreign grantor trust and you have U.S. beneficiaries, but U.S. beneficiary or U.S. person transferred something to that foreign trust. So you created U.S. grantor for that foreign grantor trust. So now you have to keep track of those trusts, how much everybody contributed, and it can become quite intensive exercise. Again, the advantages of foreign grantor trust, foreign source income, non-ECI is not subject to US tax. So if you have a pure grantor, you're non-US person, and assets are outside of the US, that grantor is not going to be subject to the US tax, and US beneficiaries are not subject to tax on distributions. So basically, they are receiving tax-free gifts from that foreign grantor trust. And there is no accumulation distribution rules, which is a nightmare for the non-grantor trust. A lot when we deal with somebody that is planning to come to the US, or they are already on yes, or they have a ticket and they're like, oh, we know because we just looked on Google or we just asked ChatGPT, and ChatGPT told us that we will be subject to US tax on our worldwide income. Can we do something? Can we just be cute and create a trust in a foreign country and just put all our assets in that foreign trust? And then let's just say, we leave US and we go back 5 years later back to a foreign country and we take everything from that trust. No, you cannot do that. So that's the first answer. You cannot do that. In addition to that, you sometimes can have an accidental transfer to a trust. One example that we have a lot is we have a lot of Australians, and most of the Australians, probably 99.9% of Australians, are going to have superannuation trust. And some of the superannuations, that is a foreign retirement in Australia, some of the superannuation trust could be seen or are foreign trusts for US tax purposes, depending on who funded and how that funding was done. So let's just say you have somebody that comes to your office and he arrived in US in 2024, at the end of 2024, and he tells you that I'm trying to prepare for my 2025 filing and reporting obligations, and by the way, a couple of years earlier, I created a self-managed superannuation fund in Australia, and I contributed 100,000 or 250,000. I think 250 is the maximum that they can contribute according to the rules in 1 year. So he contributed, let's just say, 250,000 2 years before he came to US. So what it means, it's that under 679, the transfer by United States person creates this grantor trust concept. Now you will tell me, well, he was not a US person when he made that transfer. He was completely not subject to US tax. He didn't dream about coming to the US. He didn't even know that he's coming to the US. Why that arrangement is going to be treated as a grantor trust? Well, because IRS says so. IRS tried to protect basically their rights and to avoid US people creating trust outside of the US and transferring assets. So they said, okay, even 5 years, if you transferred something to a foreign trust within 5 years that you became a United States person, that arrangement, that trust is going to be subject to US tax obligations. This matters basically when you're trying to see to help them with the pre-migration transfers, and it's basically you're not going to avoid US tax no matter what, unless you sell your asset to a foreign trust. Who wants to sell their asset to a foreign trust? And just basically, so it doesn't work. So A week ago, I was in the Hawaii Tax Institute, and Patrick Martin, he had a session, and he was talking about treaty benefits, and why I will recap why it matters, and his case arrest the United States. Most of you probably heard about arrest. It was a big case a couple years ago. It was most of the practitioners and like commentaries were about F-bar implications for that case, because tax court basically what it said, district court what it said, that according to the treaty, a person was not a U.S. person, and therefore there was no F-bar filing obligations. What Patrick was talking about, and that is something that I think that everybody has to keep in their tools for certain non-compliance. Again, it's not a blanket statement. It just depends on facts and circumstances, but something that should be considered. So I will recap ROST facts and why could be applicable to a foreign trust. So in Oeste, there was a Mexican person. He was born, raised, and educated in Mexico. He worked in Mexico. He lived and even retired in 2012. So he also purchased a property in Florida, and he started spending some time in Florida. He then decided, well, I just don't, I hated, to go through immigrations all the time. I just want a green card. So he gets a green card in 1984. The green card, I believe, expired. He never relinquished that green card. So he has this green card and basically keeps, coming back and forth. His wife became, I believe, became a U.S. citizen in 2011. In 2012 and 2013, he has more than 10,000 in Mexican bank accounts. He files a joint tax return with his wife, 1040, and doesn't disclose the F-bar. He also doesn't enclose 8838 tax treaty position. He doesn't file that. So he basically files as a U.S. taxpayer with the expired green card, a joint tax return. Then he figures out he needs to file F-bars. Long story short, he goes in OVDP, then opts out of OVDP, changes couple of the lawyers that were dealing with his case, and finally, he decides to say, well, I was not a tax resident in those years. He files amended 1040, files instead 1040 NR, and says that he takes a treaty position and says that he is non-resident for those years. And he is not subject to F-bar filing requirements. The district court goes back and forth. They say that, okay, Arrest, you are a U.S. tax person because you had a green card. But then they say, okay, you filed a tax treaty position. So therefore, you are no longer a U.S. taxpayer. IRS jumps in and says, well, it was not timely filed. A court disagrees. They say that you don't need to timely file that position. It doesn't matter. The worst case scenario, what can happen to you by filing non-timely tax treaty position, you will be penalized $1,000. Everybody's happy. $1,000 doesn't mean anything. So why arrest by Patrick, in Patrick's mind, is very important, because he is also using that right now for his tax treaty non-compliant clients, and saying that this is by the flesh language in the tax code flash language. It says that if you're taking a tax treaty position, you are stopping to be a U.S. tax resident. Of course, there are exit tax implications. Of course, like you probably could need to amend tax returns. It could be a very expensive exercise, but at the same time, it could be beneficial for somebody who wants to claim that they are non-residents and therefore they are not subject to this U.S. reporting obligation. So next, we should look into foreign non-grantor trust. Non-grantor trusts are taxed only on effectively connected and U.S. source income. U.S. beneficiaries they are taxed on their share of worldwide income, including capital gains, and they are subject to throwback tax and interest charges. And if you have non-U.S. beneficiaries and you have non-grantor trust that has assets in U.S., they will be taxed on the ECI, effectively connected income, and U.S. source income. So let's just say, you have a beneficiary that receives a distribution from a foreign non-grantor trust. You need to look into the current year distributable net income. And remember that the distributable net income is going to include capital gains. And then it's going to also include worldwide income. If your aggregate distributions exceed that distributable net income, the excess is tax-free principal, so you get something tax-free, and then you can be subject also to aggregate distributions. It's probably the worst accumulation distribution is probably the worst what you can see for your clients. You have to go through various steps. You have to look into prior years. You have to average those years. You have to calculate annual accumulation. You have to basically tax that distribution, and also you will be subject to penalties and interest. Default method. So default method, you can use default method, which will look if your distributions exceed 125% of the average distribution. If you elect default method, you can switch to actual method only later on. So it's a little bit, it could be easy. It could be if the trust is distributing every year and the amount is similar, accumulation distribution and the default method, it could be probably like easiest for you. Again, if it's distributing every year. If it's not distributing every year, you don't want that accumulation distribution. Then what you need to ask your foreign trust whether they can issue the beneficiary statement. If you can get an actual beneficiary statement, you will go by the actual calculation for the trust. Again, that beneficiary statement has to be prepared correctly by the foreign trust. It could be challenging to get the beneficiary statement. You will need to work with a foreign trust accountant. You will need to work with a foreign trust lawyer, explain to them why you need this beneficiary statement. Beneficiary statement has to be signed. Right now, it can be e-signed or it can be basically scanned to you. So it's not that big of a deal. Years ago, it had to be everything had to be signed. So we would have forms mailed to us, and then we would assemble everything and ship to the IRS. So distribution, you have to remember that not only cash is a distribution. Distribution can be use of a trust property. If let's just say, you have a U.S. beneficiary that wants, and the trust has a property, let's say a property in Miami, and the U.S. beneficiary wants to use that property in Miami, that will be a distribution to your U.S. beneficiary. Then you will need to also ask if there is a non-grantor trust that owns that property in Miami. You will need to ask your foreign trust for the financial statements. Did they have distributable net income? Your U.S. client, U.S. beneficiary, could be subject to tax even if there is distributable net income for that use of the property in Miami, even if he or she didn't receive any distributions from that foreign trust. So that is something scenario that nobody wants to have. To avoid that, probably that beneficiary would have to pay rent to that foreign trust. Again, beneficiary that will not want to pay that rent to the foreign trust. You can actually mitigate that by the trust, making sure that the trust has no income, no distributable net income. The trust also can distribute to, if the trust has distributable net income, the trust can distribute that income to a foreign beneficiary. So then there is nothing to distribute to your U.S. beneficiary. So the distributions can be mitigating for the US purposes, but again, you will need to work with the foreign accountant, you will need to work with the foreign trustee, with the foreign lawyer, and that should probably be done before the tax filing, or if it's something that was omitted for years and you have this problem on your hands for the past years, nothing can be changed. So that's what I covered. So just to recap key reporting and the penalties, why it matters. Anything with the foreign reporting is expensive. It starts at $10,000 per form, or if it's a foreign trust or foreign gift, it could be a greater 10,000 or either 5% of trust assets or 35% of the value of property, whether it's transferred or distributed. Other forms could need to be filed if you have the foreign trust. You might have to file 8938. You might have 5471 filing requirement. The trustee might be a corporation in a foreign country. That happens a lot. So you have a foreign corporation that is a trustee of the foreign trust, and your client has an interest in that foreign corporation. So you might have 5471 and 3520, 3520A filing requirements. You might have a trust, you might have a partnership also, you might have PFIX in that trust. So if you have grantor trust, everything flows through. So it could be a lot from somebody that comes to the US and has this foreign trust. There could be an avalanche of forms that you will need to file or remediate for them. So now that we covered a little bit of the foreign trust, we will look into foreign gifts. And gifts are fun, gifts are non-taxable. Everybody likes to receive gifts. Foreign person's gift, no tax, no nothing, but it needs to be reported. And it is extremely important for anybody to report that on 3520 because IRS is looking into foreign gifts. They launched compliance campaign in 2018. They said that they will be looking in foreign trust. They will be looking in 3520s. They mentioned I go to the tax forum every year just to hear from the IRS what they are looking into. And years ago, foreign gifts were not mentioned, probably 2-3 years already that IRS is mentioning, or maybe already mentioning foreign gifts. So they're making sure that practitioners, anybody knows that there is a need to report those foreign gifts. So at some point, they will probably be more strict on the foreign gift reporting requirement. Why it also matters that compliance, that there is no first-time abatement. For most of the tax forms, there is first-time abatement. There is a specific language in the first-time abatement where it says that the first-time abatement doesn't apply to the foreign trust, so no 3520 and no to 3520A. In addition to that, there is no guidance from the IRS regarding foreign retirement plans. So you can see a wide range of how foreign retirement plans are reported. You can see them being reported on the FBARs. You can see them being reported on the 8930As. You can see them being reported on the 3520As when they don't need to be reported on 3520As. So this confusion among all some tax practitioners, because there is no clear guidance created MS and 3520s may be missed, or sometimes they might be filed when they don't need to be filed. So IRS tried to remediate that. In 2020, they have this revenue procedure 2020-17. It's very limited. I was very happy when it came out. I checked it out. It doesn't apply to probably 99 of our clients because it has a very limited scope. There is a limit for the annual contribution to the foreign pension, and there is a limit to the lifetime contribution to the foreign pension. Most foreign pensions are not going to be within this limit. Again, something for you to keep in mind, like when you have foreign pension, look into 2020, maybe that foreign pension doesn't need to be reported because of that RefRock. So now let's look into my favorite part is cases, and I will start with the most favorite case is Wrzezinski v. United States is a foreign gift case, and that case was, again, it was in tax notice, it was everywhere when that lawsuit happened. So the facts are quite
Jurat, before you start, there's a question. If you,
Yep. Yes.
if I can interrupt you for just a moment, the question is, what happens when a client receives an inheritance from a living parent who owns property in a foreign country?
So there is an inheritance. Well, it's not an inheritance. Yes, it's a gift probably if somebody is still living. So it's probably if the person is still alive. The person who gifted is still alive, it's probably not an inheritance, it's probably a gift. So that gift would be reportable on the 3520. Like you have a property that you need to report. So it's a reporting requirement. And then since you have this property, and if that property, let's just say it's a rental property, and that property generates income, then that income, after it became your property, will be taxable on your individual tax return. If that property, let's just say a bank or financial account, again, it's reportable. As a gift, there is no step-up basis. So you step into the shoes of your living, like you said, parent or somebody, and you just report then income. Or if you later sell, you have this cost basis issues, which I can go into deep, because if it's a gift, you step into the shoes of the person who gifted, and then you need to look when it was acquired, and when you try to sell it, you can have completely different gain than it would be for the foreign tax purposes. Let's just say if that item was subject also to the foreign tax, if it's a property in a foreign country. Now, if it's an inheritance, inheritance is also reportable on 3520. If it answers the question. So going back to
a couple of things I wanted to add. The gift is reported on Form 3520. I think you mentioned that. The value at the time of the gift has to be over $100,000.
Sorry, yes.
So if a non-liquid or non-marketable an asset or marketable securities are being transferred, an appraisal may be required to firm up and confirm and verify the value of that gift.
Yes, thank you so much. Thank you so much for noting that. And something that we are just working right now, it is an inheritance, and it's in Latin America. And try getting a valuation in Latin America. And on top of that, because of how it works, the person, that specific person, died years ago, and everything was in accord. So there was no amount that was known to the US beneficiaries. Nobody reported anything. Right now, they are about to receive that it is a property who was purchased by that person 50 years ago in Latin America. Person died 5 years ago, and they want to sell this property as soon as they receive it. So we have this valuation issue. Try getting evaluation for the date of death that was 5 years ago, and that is in Latin America. So it can be quite complicated.
Yeah, there's another question here. Let me read it to you, Jurat. What if a friend, a foreigner, assuming a non-US person, who is living before death gifts a substantial amount of money to an American citizen? Is it taxable or just reportable?
It is reportable. If it's a gift, it's reportable. If it's a gift. So I'm assuming it is a gift. So now the next step would be because everything that you receive, IRS will say that it is income unless specifically excluded that it's not income. So for gifts, I usually advise to go, if a person is in a foreign country, go to the notary, go to the lawyer, just to document it. If somebody wants to gift a gift to US person and US person comes to me with that question, I advise them, tell that person, go in their foreign country, go to the notary, go to the lawyer, document it. If, like send emails, send letters, say, I want to give you a gift, have some documentation for yourself when you're receiving that money that you actually received a gift and not something else. It comes up when there is supposedly a gift from a foreign entity. Let's just say parents have corporation 5471 possible for the US person, but he doesn't have filing requirement, and they send that money from the foreign corporation because it's easier for them, because foreign corporation has money. You can have a lot of implications of that, because then are they paying you something? Is it income to you, or is it a gift? So I would look into all the details, and I would get as much documentation as possible, because if it's audited, you will have to basically prove that it is a gift. So going back to the case, so this one, Brzezinski was born and he was educated in Poland. He comes to US when he's 19. He's a very good he becomes a US citizen. He works as a police officer, and in 2010. His mother, who is a resident and citizen in Poland, wins a lottery, 830,000 USD, a lottery. She calls him, she's son, I want to send you money. The son goes to his tax advisor in US, who is Polish also, who's also enrolled agent, and asks him, well, my mom wants to send me more than 800,000. Is it reportable? Is it taxable? The enrolled agent tells him, no, nothing needs to be done. Okay, mom sends him money. It's over 2 years. So it's 2010 and 2011. More than 100,000 would be reportable. Years go by, IRS doesn't audit. Nobody knows about this gift. He's happy. Everybody's happy. 2018 comes. He wants to give some of the money that he receives from his mom to his nephew who resides in Poland. Then he looks online. In 2018, he already doesn't call his enrolled agent. He goes online and he starts Googling about what happens if a US person wants to send a gift to a non-US person. Thank goodness there was no ChatGPT, so he's not that scared. He would be extremely scared right now. So what he finds out in 2018 scares him. He has all those reporting obligations for 2010 and 2011. He finds a lawyer. Lawyer tells him, you had a filing obligation in 2010 and 2011. You have to remediate that, and I can potentially help you. Let's just file your late 3520s using delinquent information return submission procedure. And that I believe he files that in 2018. So years before IRS, right now they know more about 3520s. 2018, you file your 3520 with a reasonable cause attached. Nobody's reading your reasonable cause. A year, so he files it in 2018. In 2019, a year later, he receives a notice from the IRS, and they are telling him, well, thank you so much for filing your late 3520s. Here is a penalty, 207,000. Basically, it's maximum 25% penalty, despite the fact that he enclosed reasonable cause, in which he explained to the IRS that he went to the preparer in the US, that the preparer was an enrolled agent, that he told him all the facts about that gift. And he was told by the preparer that he doesn't need to file this. IRS still penalized him to 207,000. Long story short, he goes to appeals. Appeals officer removes partial penalty and leaves 5% of that penalty. So 41,500 left. The taxpayer pays the penalty and sues the IRS for the refund. When that lawsuit happened, everybody was extremely happy. I mean, the tax practitioners that deal with the international tax compliance, everybody was happy. Finally, tax court will have to answer so many questions about foreign gifts, 3520s. DOJ sees that case and settles that case, basically refunds money almost the next day without anything, without asking for any additional documents, nothing. They just pay the money and that's it. Case is closed. So good for him. Good for Brzezinski. He got his money back. Not so good for everybody else who waited for the court to discuss more this foreign gift issue. So we have other case that is when somebody gives US person, gives money or makes a transfer to non-US person. Schlafner v. Commissioner, it's more like adequately disclosed case. There are a lot of issues in this case. So if somebody is dealing with transfers from the US person to non-US person, I think it's a good case to review because it also court goes into a lot of discussion of what is adequate disclosure is. Because in this case, quickly, there was a gift that was incomplete gift, and it was disclosed to the IRS in 2006 form, and it was completed in 2007. IRS came back after the taxpayer and after the 2006 year was closed, and they claimed that it was not completed until 2007, they still have statute of limitations and they can penalize the taxpayer. Tax court looked into the adequate disclosure standard and said that no, in 2006, it was notified IRS, you were on notice that the taxpayer was making a gift, and basically the statute of limitation closed. What is missed in this case is that the taxpayer claimed that he was a non-US person in 2006 and 2007 when he made those gifts. He applied to be a US. He applied for green card and then he applied for the US citizenship right after those years. Nobody looked into that he probably was domiciled in US. I don't know why, but that case basically doesn't even look in domicile issue when he claimed that he was non-domiciliary in those years when he made a gift. So those were gift tax court cases. Now, Uland 1 and 2 is a foreign trust cases. And Uland 1 and 2 is just because it's 2017 and 2018 issue. It's about a US taxpayer who lived in Australia from 2011. He was compliant in US. He was one of your exemplary taxpayers. He lives in Australia. He files Australian tax returns. He also, I believe he had a business in Australia, and most likely he had self-managed superannuation, meaning that he had a pension plan that is treated like a grantor trust because he funded that pension plan. And therefore, he has 3520 and 3520A obligations. Now, if anybody of you deal with Australia, you know that Australia doesn't have a calendar year and it has fiscal year end. So that becomes a challenge for the US tax return preparation because all the financial statements are prepared on the fiscal year end. So he files 2017, 1040, and 3520. And I didn't mention to you this, 3520 has a same due date like a tax return. So there is no separate extension for the 3520. Then extension to file 1040 also extends 3520 filing requirement. So as long as you file that 3520 by October 15, if there is an extension, you are fine. There is no extension if you are in international tax area and you have a US person who lives outside of the US, there is additional extension that can be requested from the IRS to file the income tax return until December 15. That extension doesn't apply to 3520. So 3520 extension, just a regular extension until October 15. 3520A, the one that the grantor has to file, the one that reports a balance sheet and income statement, it has March 15 deadline, meaning that it has to apply for the extension. You have to mail that extension. It cannot, at least up to 2024, it cannot be e-filed. You actually physically have to mail the extension. And it's very important to file that extension because the penalties can be severe. So then the 3520 has September for the calendar year, September 15 filing requirement. In this case, is June fiscal year end. So the taxpayer files the extension, timely extension, extends the due date until March 15, and files then 3520A 3 days before extended due date. So we are dealing with 2017, 18. So something that was filed in 19. Late 1920s, 21. That's in my practice, those were probably the most horrible years with the IRS and extensions for the foreign trusts. In this case, what happened, again, IRS assessed penalties just because they just with no reason for why they took money from our taxpayers' refund from the subsequent year. And the taxpayer went even to the court. Again, the case was dismissed when they saw what happened. I had a lot of similar situations in those years, and probably my worst case scenario was like Raj mentioned. I had a law school, and basically that year was my first year in the law school, and I'm in my capstone in Minnesota, and the email comes from the client with 2 notices attached, and the total amount for the penalties, a couple thousand less than $1 million. So I'm all happy. I'm sitting in Minnesota. I have those 2 penalties with almost $1 million. I know that we filed extension. I know that we did everything. We have tracking number. Extension was delivered. When I was back at the office, I called the IRS. It took us probably 2 years to solve that issue. That's how long it can be, any issue that involves foreign trust. IRS again, 2020, 2021, they had no clue about 3520A extensions. They were not linked to the grantor's social security number. So while the extension was filed under federal ID of the trust. Every foreign trust needs to have a federal ID. So while it was filed under that ID was not linked to the individual, and therefore, for some reasons, they were issuing those penalties. I do not see those penalties right now, but basically, I think they are much better how they are dealing with extensions. But anytime you receive a penalty, you always need to check and just be persistent and make sure that everything is applied correctly. Ulant 2, 2018 case. So that was very interesting. The facts were 2017, the taxpayer was, I know I filed, he had records that he filed that on time. 2018, he was a little bit weak and he was, I always filed on time. I'm sure I'll file this extension also on time. And then he said, well, in addition to that, IRS, you were also not exemplary in those years because COVID started when my extension was due, and probably you lost. You even said publicly that you had problems in those years. So it's your problem, not my problem. After Ulant won, this case also goes to the court. DOJ, for some reason, dismisses that case with not even any support that the extension was filed. Very interesting case. I don't know why they dismissed. Maybe a rumor has it that maybe they didn't want to discuss foreign trust. They didn't want to discuss, in addition, maybe superannuations, because everybody was hopeful that maybe superannuations will be discussed. They dismissed the case. Everything is dismissed. No clear answer from the IRS. Another case that is still pending in the court is jeopardy assessment. For you to know that if you're dealing with international assets, international clients, a high tax amount, there could be jeopardy assessment. And in this case, there was a trust. There was a trust that was established long time ago. And then there was a US resident who was a beneficiary of that trust, and he got a green card. Why it matters for our discussion is how he treated that foreign trust reporting. So he gets a green card, then he gives it up. He is covered expat because he had that green card for more than 8 years. And then he decides when he gave up his green card that he has to remediate his non-compliance regarding this foreign trust reporting. So he goes and hires somebody to remediate him on the voluntary disclosure program, and he files not only 3520, but he also files 3520A. So again, this is a trust that was established by his dad in a foreign country, and he files 3528 treating this trust as a grantor trust, meaning that it's a lot of implication for his compliance. He will have to include in his income, in his US income tax returns, the trust income, and that trust is an asset that will be subject to exit tax because he exited US in 2010. And he put that 2010 under the voluntary disclosure program. What is interesting here is that when they discover, his advisors, that he filed or they filed that 3520A, which is a little bit incorrect, they go and file amended tax returns and say that 3520 was incorrectly filed. Tax court agreed about, the IRS agreed initially, and then they assessed him additional penalties. So where this case sits right now, it's a jeopardy assessment. The district court said it was, IRS was correct that they assessed them. But the 3520 and 3520A issue is still in the court. And it's very interesting to see whether the court is going to agree that initially filed 3520A can later on be amended and say, oh, oops, we made a mistake and there is no grantor trust, and we instead just filing 3520. Sorry. And trust classification. So at the beginning, I mentioned why it matters how that entity is classified for the U.S. tax purposes. In this case, we have Fairbank, who was it's Fairbank, who was, I am looking for her name. She was Mrs. Hageman prior to becoming Mrs. Fairbank. So Mr. Hageman was a CPA in late 1970s. So he then became an oil broker, and being a CPA, he said, "Nope, I'm not going to file U.S. tax returns." He doesn't file a couple tax returns. He moved 16 million to Switzerland and New Zealand in early 80s. In that time, also they start divorce proceeding. IRS sends them notices. She, Mrs. Fairbank, in 1990 receives innocent spouse relief from the court. And she's not subject to any liabilities that her ex-husband has for 81 and 82. They have this divorce and child support agreements, and she says, in 83, I will have somebody else establish Xavana, so-called Xavana establishment. And my Swiss attorney creates that establishment, that entity, and she is listed as a beneficiary in the documents. There is nothing, there is no trust name, nothing. It just says Savannah Establishment. That's the name of that entity, but she's listed as the beneficiary of that entity. Later that year, when this establishment is created, there is a UBS account open and under that Savannah Establishment name. Again, in the documents, there are instructions from Mrs. Fairbank not to send any statements from UBS to her Florida. She now lives in Florida. Florida address, everything should be kept at Savannah Establishment. Now, we know what happened with UBS. 2008 comes, IRS issues John Doe summons and gets all the information. In 2010, IRS sends a letter to Mrs. Fairbank regarding her accounts. Her tax returns are also selected for the examination. She and her new husband, they meet with the revenue agent that is assigned to their matter. It was 2012. So she retains a counsel. She files 5471. There is another entity. So she files 5471 for another entity that's regarding foreign corporation, not the man establishment. She files FBARs, but she doesn't do any disclosures regarding the van establishment. The key fact here, what they are going to use for the court, is that she showed all the UBS statements that were issued for the Savannah establishment to this revenue agent. So she showed all the bank statements, she disclosed everything to him, but never filed 3520 or 3520A. She is listed as a beneficiary. IRS audits those years, looks at all the forms, and says, well, there is a foreign trust. So the court has quite nice explanation how they arrived that entity is actually a trust for the U.S. tax purposes. They looked to the code section, they looked to the regulations. They said that it was the only purpose of this establishment was to keep the property for the benefit of Mrs. Fairbank. And that property was just a bank account, only one investment bank account. So you have the bank account that is basically your trust. 3520As were not filed, 3520s were not filed. What they say is how they go to the tax court, and Mrs. Fairbanks says, well, I'm not subject to penalties because the 3-year statute of limitations passed. I filed all the tax returns, I disclosed everything, and I showed to the agent those bank accounts, UBS bank accounts. So IRS knew about this account and they knew about this so-called trust. Therefore, statute of limitations closed. I'm not subject to penalties. Court says, no, no, no. You had Form 3520 and 3520A filing requirement. And as most of you probably know, if there is an international asset, a foreign asset that is omitted from the tax return, or if there is a foreign form that is omitted from the tax return, the statute of limitations never close. So the IRS in this case, they went back to the beginning, to the actually beginning, when that entity was open, and they assessed penalties for every year for the 3520 and 3520A non-filing requirements. So this case, I think, is quite interesting. It shows that IRS, in reality, they can actually go back and look into your clients if they were not compliant, if there is something that had to be disclosed and was not disclosed, they can go back years and years and years and assess those penalties. Something else for like practical issues, what I see a lot when we deal with international trusts is you're dealing, most likely you're dealing with a foreign person that came to the US. That at least 80% for our cases is somebody who arrived to the US and they have, it's either a foreign trust or they are receiving gifts or they are dealing with inheritances from the foreign country and getting documents. Getting documents and proper documents that you need for the filing. Financial statements, let's just say Australia, different fiscal year end. UK, different fiscal year end. So you have this problem that you have a US person that is subject to the calendar year filing requirement versus a financial statement that most likely is prepared based on that country's way it is, fiscal year end. We try to work a lot with foreign accountants and explain to them that they need to prepare financial statements based on the calendar year. Some of them do, some of them don't. So then you have a different year end for US tax purposes. You can have a lot of PFICs in those foreign trusts. PFICs will cause your US client to be subject to additional tax, additional possibly interest charges. So PFIC and foreign trust probably goes hand to hand if you have a trust that is heavily invested in a foreign country. Again, UK, Australia, a lot of PFIC issues. Like I mentioned before, those forms have to be filed, paper filed, at least up to 2024. I'm not sure about 25, but they are paper filed. And so you need to keep track that you timely file, or if you have your client mail, we usually mail the forms from our office. I either have clients coming to our office and signing those forms and we mail, or we get signature pages and then we assemble those forms in our office and we mail to the IRS. I usually do not have the client mailing those forms. One time we had, just because it was close to the extended due date. We have an issue because client claims he mailed it from Australia, mail was lost. We had to resubmit all the forms. So the only time when we filed it something happened. So I usually prefer that we file those forms from our office and we keep track. We send them a certified mail or FedEx.
Jurat?
Mhm.
Yes. So we are over our time.
Oh, sorry.
Do you want to make a couple of closing comments?
Yep. So I think facts matter. Facts matter. If you're dealing with somebody that is non-US, ask them questions. Ask questions. Ask them. Clients are not going to volunteer. Most of the clients are not going to volunteer. They also don't know. They do not know. They come from the foreign country. They do not know that it's a lot of compliance requirements. So just educate them and ask questions. And a lot of the issues can be prevented if the questions would be asked and then you look into, into additional compliance and basically file those forms. If there is non-compliance, it's a lot of ways that you can put them into compliance. It's going to cost your client, but it's not end of the world. It's just compliance issue.
Yeah. Thank you very much for this informative presentation and the slides. Uh, Jurat's contact information is on page 1. If you have any follow-up new business opportunities,